Hey everyone, Tom here, and welcome to the Advanced Trade Plan video in the Power of Two module. So let's jump straight into the video. Again, this is in relation to our Power of Two, a high time frame trading strategy, which most of you should be pretty familiar by now. You would have gone through the theory, the essentials, and touching on the advanced series here now. So in this video, we're pretty much going to cover our 4-hour range building. After that, we'll go ahead and touch on 4-hour directional bias. This is in relation to follow-through, no follow-through, strong follow-through, and counter trend trading. Following on from that, we'll look at 4-hour scenarios. So this will be a clean looking workflow that you guys will have access to, and you can do as you please. It will help you guys out with filtering some of the scenario noise there. After that, we're going to touch on trade execution. We've got 15-minute external ranges, 15-minute internal ranges. We've got our session timing and the management of trades. So firstly, let's touch on 4-hour range building. So what we want to do with a clean looking chart, we're going to plot, when I say clean, I mean blank chart, yeah? Nothing but the indicators that we use on the chart, no other lines. We want a clean looking chart, just the fractals and the sessions indicator. We want to plot the most recent range high and low. We're going to note this as our current dealing range. In this sense here, we've got a bullish scenario. So we've got a breach of a high here. We print these fractals, and then we're looking at the most recent fractal ranges here. So this fractal low, this fractal high, we can denote these as our 4-hour range. Therefore, our 4-hour current and most recent dealing range. Now that dealing range, or these fractal highs and lows, we refer these to as the most recent pools of liquidity. These are going to be the freshest and the most relative pools of liquidity. That's why we use the most recent. So now we have our 4-hour sort of dealing range. We now can move on to a premium and discount market. When we're buying and selling anything, we want to buy it cheap and sell it high. In currencies, in FX, in the financial markets, it is no different. We are merely buying cheap and selling high. So to define this or draw these premium discount zones on, we have our 4-hour dealing range, high and low, or low and high, and we go ahead and grab the Fibonacci tool, which is defined with a 0, 0.5 and a 1 level. This is going to give us our premium and discount. So in this sense here, we've got again a bullish scenario. We've got our dealing range low, dealing range high. When price comes into discount, which is the lower 50% of this dealing range, that's when we'll look for our buy opportunities, because we are buying in a cheap market. We're buying at a discounted price, pro trend, following that 4-hour range. And then the upper 50% is our premium market, and this is where we'll be looking for sells. We want to sell that currency when it's in a premium pricing. Yeah. Same here, we've got a high and a low here, fractal most recent dealing range. Draw on our Fibonacci. This is our premium, therefore we want to be selling in this market, and the lower 50% is our discount. And we want to be buying in that market. So the 4-hour range building in its essence is rather simple. If you strip it back like this, I urge you guys to, with this knowledge now, to go ahead and jump on the charts and plot out over the past couple of months, stay on that 4-hour chart, plot out your dealing ranges, and just do a bit of practice that way. And you can then practice of putting your Fibonacci tools on. Now we have our 4-hour range set, we move on to 4-hour directional bias. Kicking things off here, we have follow through. Now follow through, or FT, is a 2-candle close above or below a fractal high or low. So let's start on the left here. We like to use if then statements. So if we body close once, then we wait for confirmation of FT, as this is an unconfirmed bias. So for example here, this is a fractal low. We've got this one body candle closure here. So we need to wait for the next candle to close, because in this sense, when you've only got a one bearish body closure on this fractal low here, it is an unconfirmed bias. And then if we wait for the next candle, as you can see here, again, we get another bearish body candle closure there, and we can assume that this now is a follow through environment. Same again here. If we get a 2 candle close on fractal, then that is FT. How I was talking about here, you know, we've got a wick here, so it's an NFT, but then we get 2 candle closures there. What we want to see is 2 bullish body candle closures above that fractal high. That high price point, that is the price level of that, 2 bullish body candle closures, and it is an FT. Same here, 2 bearish body candle closures, looking for an FT there. Now moving on, we have a no follow through, or an NFT. So no follow through is merely a failure to give a 2 candle close above or below a fractal high or low. So when we wick a fractal, then that is an NFT pretty much, whether it be a fractal high, fractal low. If we wick that, it is an NFT. Moving on to another scenario here, if we get a body closure, similar to how I was talking about in an FT environment, if we body close once, then we have to wait because this is an unconfirmed bias. Then, translated again, we wait for the next candle. If that closes bullish here in this sense, in a bearish, a fractal low, bearish candle closure, once unconfirmed, we then get a bullish body candle closure. Therefore, this is an NFT. Now we have strong follow through. Is a adaptation of a follow through, something we picked up. And this refers to if we body close once, then we need to wait for confirmation of FT, as this is unconfirmed. You'll see a pattern here. When we get that single body candle closure, there's 3 different scenarios that can happen here. On the next candle closure, we're either going to get a NFT or an SFT. Yeah. And then as price and time moves along, that might transition into something else, but that remains to be seen. The workflow will help visualize. So an SFT is merely if we body close with 2 consecutive candles, then we are SFT. So like this sense here, we had that single bearish body candle closure, therefore we are unconfirmed, then we get another one, signaling that we are in an SFT environment. SFT and FT, there's not much in it. They're kind of SFT is an adaptation of an FT. So if we for example, on the FT chart back here, it's quite a good one. See here, we get that wick first, then 2 consecutive. This is FT. It's not SFT. Yeah. The SFT is those double bearish body candle closures on a fractal low, and on a fractal high it'd be a bullish body candle closures. So now we know sort of our pro trend environments. We can now look to trade counter trend and go against the trend and capitalize on moves that do make sense. If we're looking for a pro trend move and we want price, for example, to get into a discounted market, we might as well sell, and we might as well capitalize on those sells inside premium before we take up those buys to follow the trend. So when we look at counter trend trading, we can counter trend every single directional bias. So we've got counter trend no follow throughs, we've got counter trend follow throughs, and counter trend strong follow throughs. So with a counter trend NFT, we have an NFT bias. So we can look to buy or sell in the opposite direction of that bias, if that makes sense. If we are in premium or discount respectively, so let's just touch over to NFT here. So in this sense here, when we've got an NFT and we've got our dealing range, we'll be looking for sells here. But if we are inside discount of that dealing range, we can then go ahead and look for some buys. Even though the overall bias is bullish, we can capitalize on those counter trend trades. Same with FT here. When we have an FT bias, we can look to buy or sell in that opposite direction of that bias if we are in premium, discount respectively. Again, so for example, if we've got this dealing range here and we've got an FT bias here up on this fractal high here, we're looking for buys in discount. In the meantime though, what have we got to do to get to discount? We're going to have to sell, and we're going to have to come down inside past premium into discount. So we can capitalize on these counter trend FT, NFT trades in this sense, counter trend NFT, so we can sell in a premium market here. Same with, for example, this here. If we had an NFT on this fractal low, we'd be looking for buys in discount. We can capitalize on sells in premium if it all aligns up. Counter trend trading is almost taking those directional bias and almost flipping them on their head. So when we have an SFT bias, we can look to buy or sell in the opposite direction of that bias. Again, a common pattern here. When you have your directional bias, whether it be FT, NFT, SFT, counter trend trading is kind of almost flipping that on its head. So like I said, with the NFT, if we're looking for buys in discount, we can capitalize on sells inside of a premium market alone. Do know the risks involved with the counter trend SFT. It can get quite confusing. I urge you to heavily do your backtesting on each scenario, and whatever works for you, then you can go with that. So here we have just a brief and quite detailed or quite informative scenario list of each scenario and how they can play out. So let's start from the left. We have an NFT. Is it on a fractal low or a fractal high? If it's on a fractal low, we can look for, it's a bullish market, therefore we buy in discount, but we can capitalize on counter trend NFTs. That means we sell in premium. And if we track back, if we're on an NFT on a fractal high, we're in a bearish market, therefore we sell in premium. But what we can capitalize on is counter trend FTs, and that means we can buy in discount. Moving on to follow through, we've got a fractal low, therefore the directional bias is bearish. We therefore can sell in premium, but also know we can capitalize on counter trend FTs, therefore buy in discount, even though it's in a bearish market, yeah? Because we are counter trend. If we have an FT on a fractal high, we're in a bullish market, we want to buy in discount, and know that we can, if we get counter trend of those, we can then go ahead and sell in premium, even though we're in a bullish market. Yeah. And moving on lastly to SFT. If we've got a fractal low, therefore we are in a bearish market, we can look to sell in that market and omit premium and discount because it's a strong follow through. We want to capitalize on that strong nature. But we can know that we can capitalize on counter trend SFT, and that is a buy in discount. When we're looking for counter trends on SFT, you want to bring back, discount and premium to stack those probabilities. SFT on a fractal high, therefore we are a bullish market. We can look to buy and omit premium discount, and then we can also capitalize on counter trend SFT, but remember to bring back premium if we're looking at counter trend of an SFT environment. So by now, you're familiar with the 4-hour range building, 4-hour directional bias, you're familiar with the scenarios that can play out. Now let's touch on the trade execution. And if we look at a generic entry from the basic trade plan series, we know that the candle that took liquidity of the fractal low or high, this is our entry candle. We want to place a stop order on the high or low of that candle. So In this sense here, we've got a liquidation of a 15-minute fractal low, and this is the candle that took that liquidity. Therefore, we want to put a buy stop on the high of that and wait for it to get tagged. In this sense here, we've got a fractal high. This is the candle that took liquidity. We want to put a sell stop on here and wait to be tagged. Now, initially, if we started to move higher on these generic entries, we would merely leave our sell stop alone, extend the stop loss until it becomes, over on EU over 22 pips or something, or 21 pips, or until it doesn't make sense anymore. Yeah. Now we can look at extended sweeps. This is really extending that liquidation following 15-minute candle ranges and then capitalizing on them when they break out of the range. Yeah, so in this sense here, we've got a 15-minute fractal low. The liquidation occurs. This is the candle here that took that liquidity, but what happens is the next candle after that breaks lower. When it breaks lower, we have no entry here anymore. We can remove that order. There's no tag, and it's broke the low of this. We can remove the order, and then now, when this candle closes, we put our buy stop on the candle here that extended the sweep. As you can see, these 15-minute candles are lower, and if they continue to go lower, we continue to follow it down and wait for a 15-minute candle breakout. Yeah. In this sense here, this is the opposite. So it's if we've got a fractal high here, this is the candle that took that liquidity, and initially our sell stop will be down here, but what happens is the next candle, no tag on the entry, but it goes higher. It breaks the high of this 15-minute candle and extending the sweep. You see that continual higher highs here. So we'd move our order to this low here, but then what happens the next candle? It breaks the high, so we'd remove that order. And then when this candle closes, because it's gone higher, stop order below the low. If we get tagged, we get tagged. If we breach the high, we remove the order. Yeah. So that is a typical sort of 15-minute entry. Let's have a browse onto our 15-minute external ranges now. So if our directional bias is bearish and we are in a premium of a 4-hour range, then we can look for an entry. The entry that I just spoke about. Yeah, the 15-minute ES entry, the extended sweep entry. And the 15-minute range being the most recent fractal high and low, we will draw those on. Sorry, not the most recent fractal high or low, it's the most recent sort of range high and low of the 15-minute external range. And yeah, if our direction is bearish, we are in a premium of the 4-hour range, then the entry is valid if it's inside session. And to flip it on its head, if our 4-hour directional bias is bullish and we're in discount of the range, then we can look for an entry, because you see this here, our 15-minute external range, liquidation, 15-minute entry candle as just spoke about, entry. So that's the external range. Here we have the 15-minute internal ranges. Again, valid trades. Capitalizing on the internal liquidity of a larger 15-minute external range. So if our 4-hour directional bias is bearish and we're on a premium of the 4-hour range, then we can look for an entry. And what we've got here, we've got our 15-minute external range. We therefore build up internal liquidity inside this range. And it's the most recent fractal highs or lows inside this range, and that internal liquidity is defined by this inside box here. And if we see a liquidation of that, we can look for an entry using that 15-minute extended sweep that we just spoke about. To flip it on its head, you can see we've got our external range here, similar to this. We can go ahead and draw on our internal ranges here, internal liquidities. Inside this larger 15-minute external range, we see a liquidation of that, then we can look for an entry. Now let's touch on session timings. Core sessions for us were 8 AM until 10 AM is the London session, and 1:30 p.m. to 3:30 p.m. is our New York session. Now this is UK or London time specifically. For your time zone, you will have to convert London to your time zone and adjust accordingly. Now, with the advanced side, we've brought in extended sessions, and all that is starting the session 30 minutes early. So it's valid to take trades 7:30 onwards for the London session, and likewise from New York 1 p.m. onwards, therefore denoting the name extended session. Now let's touch on management of those trades. Now we've got our 4-hour nailed, we've got our 15-minute nailed, we know our session timings. Now we've entered the trade, let's talk about management. So our generic management, once triggered into the trade, you want to target a profit of 3% or a 1 to 3 risk to reward. Now the risk that we do per trade is 1%, therefore our profit target is always going to be 3%. Yeah, so if we're in if we've got a 10 pip stop loss, our TP is going to be 30 pips. And if we look at max risk exposure, it's 2%. So at any one time, we only have 2% max risk on the account open. So for example, if you're trading EU and GU and you've got a position open on each one and another trade is set up on EU, for example, in New York session, then we won't take that trade because our max risk exposure has already been hit at 2%. Yeah, so just be mindful of that. That's a good tool to help filter the noise, keep you patient, and reduce the damage there. We can also move on to sort of that pivotal management. And when we look at an SFT environment, we at least want a minimum 1 to 2 to the 4-hour high or low. If we've not got that, then it's not worth the risk to reward. Say it's similar to our generic management. During your backtesting, you'll get a gauge for sort of how big your stop loss wants to be, like the max stop loss you can use. Where are you relative to the 4-hour dealing ranges? That can really give you a sense of, is the trade worth taking? And that's going to come with experience, time on the charts, and just back-tested data really, and forward-tested data. It's really going to help you with that. This advanced trade plan video is merely there to just give you tips and pointers. The rest is up to you guys, yeah. So that is the end to the advanced trade plan video. Thank you for watching. Again, ensure you do adequate backtesting. Like I said, this is a guide and tips to help you along the way. It's now in your hands to go ahead and backtest and forward test, create your own plan, and then move forward with that. As always, any questions, not hesitate to contact me, Scott, or Callum. And thank you for watching, and I will see you all later.